Everyone is watching the Fed and mortgage rates to indicate what's happening in the real estate market. But there's four other signals you should be watching that are actually much more informative on how the market is doing and what to expect.
Yeah, there's four things I think that all need to line up, right? Like that's the purpose of this live is to, if you guys focus on these four things, then you can eliminate a lot of the noise, I think. All right. And the first one is about inventory. So I went through 08, like I saw inventory, right? And so there was a lot of stuff going on, pre 08, obviously, and even after 08. And everybody's like, we're stabilized, we're not stabilized, we're crashing, we're not crashing, all that kind of stuff. I went through a serious one personally. So let's talk about inventory first, right?
Yeah. So there is supply and there is demand. And that's what the whole entire housing market runs on, right? So back in 2020, we didn't have any supply and we had a huge demand because interest rates dropped. Right now, we have more of a supply than we do of a demand. That's why it is a buyer's market. That's why, there's more inventory sitting, is because there's not that many buyers. Now, a lot of people will say we have a pent up demand, like we have a demand for buyers. They just can't afford these mortgage rates. But either way, we're not seeing as many home buyers as we are home sellers.
Yeah. And I think the other thing is there's some shifts in the, how people are buying, why they're not. Obviously, we'd be remiss in not discussing, there's millions and millions and millions of people sitting on these low interest rates, right? They want to, but they're like, right now my rate's low, my mortgage is low. I'm just going to stay put. So a lot of those people would normally, be upgrading, be trading, be, let's say moving into something newer. And not all of them are relocating across the country or for jobs or anything like that. So there's just this kind of natural attrition that we all see. When you've lived in a home, for some period of time. Now, don't forget, there was a huge piece of the sector that also, from a tax standpoint, would, buy a piece of land, build it, move into it, and then there's a certain period of time where they can move that into, I think it was a 20% capital gain, and then they would go do that again. So all that's kind of frozen right now, and so there is this pent up, but we're a long way from rates getting low compared to where they were, right?
Yeah, so you have to look at the supply. And what I like to do is I like to pull up 2019 versus now because, that was pre everything getting crazy. So it's good to compare the two. So right now we have a 4.6 month supply nationally. In 2019, it was 5.5 month supply.
Let's pull that chart up, Jerry, if you would.
So, you're having a bigger, you're less of a supply than you were in 2019. However, we are seeing that tick up. So it could be an indicator that could, lead to more price cuts, etc. So you do want to keep an eye on it.
Yeah, I think if you look at the very bottom of this, these are some market signal indicators. The month supply, of course, is up there. Now, this is nationally. Now, we know that this is different for each economy, right? So right now, there's a 4.6 month supply nationally. Now, just to put that in perspective, in 08, it was over 10 months, right?
Yeah.
And then now let's go all the way up to the upper right corner.
No, let's not get there yet.
Okay.
But what I do want to talk about, Jerry, if you can pull that down, is that Phoenix, though, because Phoenix is one of those bubble markets, right? And so, it goes up, it goes down. It's not as steady as when you look at like an all national market. So Phoenix right now has a 4.5 month supply, but in 2019, it was 2.5 month supply. So that's why, in some of these markets, the differences are more stark than maybe the national average. And in other markets in the Northeast, you'll have a much less supply, even less than the national supply than you did in 2019. And that's why every market is a little bit different. But generally, we're not seeing any indicators in any market that there's this crazy amount of supply.
Yeah, and Jerry, pull that back up if you would. But also one other thing, when there's 4.6 months of supply, What was average in 2019 was 5.5. So that's important. Yeah. So we're not even at what 2019 was. And by the way, guys, there's nobody on this live that would say we were in a crash or some kind of a crisis in 2019. No one. So we're not even back to there. But in the upper right-hand corner, I want to bring up something that we identified as we were going through this. That's the current builder supply. Now, this, I think, is something to watch. So what you have is you have a healthy market. You have the 2019 supply, which is what we're looking at, which was about 5.5. And then you have the 2008 crash. But what we have is we have builder supply at 9.5 months. And so we've been talking about this. So this is over double than, the normal housing market. And so this is a big indicator, and you're starting to see this. You're starting to see these rate buy downs and these big builder concessions, and you're starting to see all this stuff package up. And this is precisely why Warren Buffett just made some huge investments into these single family home markets, because clearly when you have supply like this, you're not getting the profits, you're not getting the margins that you were. The other thing that this does is it actually pulls back supply. So if you have this kind of supply on the market, let's say, and of course this is nationally, then what you have is you have builders that are not going to continue to be building, because when when you're discounting homes and you're doing these big rate buy downs and you have these big marketing costs and all these things are happening, the last thing you're doing is pulling the trigger and starting to add more supply. So that's why I think this is a really important.
Yep. And so the second thing that you want to look at are days on market. When you have a higher supply, obviously the days on the market are going to go up because people have more choices. So right now, nationally, it's 47 days on the market. And in 2019, it was 34.
So it's higher.
So it's higher. And I actually have some reasons for that, right? Because I think that the sellers today, most of them do not have to sell their home. So they're letting it sit longer. So in 2019, people wanted to get their home sold. So what are you going to do? You're going to lower the price. You're going to take lower offers. Sellers today are stubborn because a lot of them don't have to sell.
Yeah, and I think this is a national number. I mean, you start to look locally, like where we live in Phoenix, it's 57, right?
And it was 68 in 2019. So you're generally seeing, like in Phoenix, the days on market is less than it was in 2019.
Right. So this is the second indicator, obviously the first one being inventory. But days on market are just what I would call an early indicator. So right now, as Danille pointed out, in many areas, it actually still is a bit of a buyer's market, right?
Yeah.
Oddly enough, like even with all this stuff. So you can't have a crash in a buyer's market. Well, I guess you kind of can.
You're going backwards there. You can have a crash in a buyer's market.
Well, what I'm saying is that we're not at the YouTube videos right now. A lot of them online are crash bro. And the point I'm trying to make here is that we're not even close. These are normal numbers.
We aren't close, but it is going up. So there is something to say for that, because, your days on market were a lot more different. We're going to get into that later in the video, even in April of 2025 than it is now. So if we see the trends continue to go up, you could get in crash territory. But the question is it going to continue to go up? But we're certainly not there now, to your point.
Yeah, all I think that's happened is we went from a very severe seller's market to now we're getting back to what is considered normal or average. And people are just freaking out because it's so much different than
I do want to go under the data, though, because you're just saying that, but we're going to be going over the data later in the video.
So my data is that Phoenix is 57, and in 2019 it was 68. That's the data I'm using for days on market. And, if you look at 2019, we were not in any sort of a crash, not even close. And we're not even at those numbers right now.
Well, we'll get to that. But as you can see, the data keeps going up. So if it continues to go up, we're going to have a problem.
You realtors, you hang on these little increases, right? Like you got to back up from the big picture here. Like nationally, it's 47, and it was 34. So yes, that obviously something. But like in Phoenix, it's 57, and it was 68. So we're not even close. And by the way, if you go back to 2010, 2009, it's off the hook. Right, we're not even close. We're not even.
Well, you're
close.
just jumping a lot ahead. So let's keep going.
All right.
So the third factor you guys have to look at is the list price and the sold differential. So basically, what homes are listed for versus what they're actually selling for. And it's hard to see this without a realtor because on Zillow they don't show any any discounts that they got off of the home that weren't affected into the price, right? So like any kind of concessions that were there are only showed to a realtor on the back end of the MLS, which is kind of BS because you can't really see it. And most homes that I'm seeing do have 1% to 3% concessions, but that doesn't really count in the sales price. But the sales to price ratio right now is 99%, meaning the houses are selling 1% below their list price.
That's not a crash. Not even close. Here's the thing. The cure for high prices is high prices, period. So what happens when homes are highly priced and then there's stress in whatever a seller thinks is stress. In this case, apparently it's 57 days on the market. Well, then they start to lower, they start to discount. What, 1%? That's not even close. That's nothing.
Well, they're discounting more than 1%, but what the home is selling for is 1%. So if somebody lists their home for $500,000 and then they lower it to 580 or 480. Then it's selling for 1% below that.
1% below that, right? So when you price something high, based on yesterday's news, which is what you do, which is what you realtors do to try to get listings, you basically tell us what you think they can sell for, and then they get discounted later by the market. But let's don't forget about the realtor, the realtor. What do you call it? Fuzzy math, where they're just trying to get listings, and essentially, not everyone's like that. But what's happening is that these sellers are, you're looking at comps from a year ago, and you're saying, oh yeah, we can list your house for that, and then you do it, and they don't, and all of a sudden, what do you blame? You blame the market, which is the market was already priced in, but you can't get a listing that way because the seller is going to go with the person that's going to give them the highest listing amount. So that's all that's happening right now is there's an adjustment going on between people trying to get listings. And by the way,
I would disagree with you there because it's typically not the realtor that's giving you a high number. It's usually the customer that wants the high number. And a good realtor is going to bring you down to earth with things that have sold in the last 3 to 6 months. But to your point, if a realtor is just trying to get a listing, they'll agree with you.
I agree with that. I think that it's a fine line, and I've been in this business a long time. It's a fine line. I see it in the commercial business as well. We get it when we get broker's opinion and value. We get high, middle, and low, and that's probably the right way to do it. The sellers are largely unsophisticated, and they're going on Zillow. Obviously, you do bring a good point here. I mean, a good realtor is going to call it the way they see it, but at the end of the day, this is, and the realtors are. They've gotten whacked because there's not a lot of sales. There's a lot, all this stuff's happened as a result of high prices, high interest rates. Sorry. So when you have high prices and high interest rates, there's an adjustment. That's what's happening right now is there's an adjustment, except in the ultra luxury market where people are still paying all cash. So there are markets in Scottsdale, Paradise Valley, where, this does not, people just buy what they want to buy, based on lifestyle and where they want to be. But the normal markets, I think, are just going through a price correction as a result of this lag in higher interest rates. And I disagree with you. I think the realtors, if you haven't gotten a listing, you haven't gotten a sale, and you know your production is 20% or of what it was in the last couple of years, you're going to do anything and everything you can to try to get a listing. And that's not always, obviously there's a stretch number. And so, that's usually typically what the proposal is.
Maybe. I don't know. I feel like as a realtor, you have to pay to do a listing. You have to pay for photos. So I wouldn't want to take a listing if I didn't think it was going to sell for what I was listing it for.
Look at what's happening even here. It's getting listed. And then you go to the seller and you go, we haven't had any showings. Maybe we should consider a price reduction. That's all that's happening. And that is so far from a crash market. That is just that. Again, I have no problem with people looking in the rearview mirror and with comps and all that stuff and saying this is what the market has been, but that's not where we're headed. These higher interest rates and also we haven't even gotten into the financial capabilities of some of the folks that are trying to get into these houses. And we're not seeing huge reductions in home prices, by the way.
No, we're not. And people that want to point out that one listing that they found that had a huge reduction, they just listed it too high. And we're seeing that too. So
I think we're just heading back to what irrational exuberance is what I would call it with the seller. The seller had an expectation, and they're having a tough time adjusting to the current market. And that's what's happening. We're reverting back to the mean, which is exactly what is normal. But there's in no way is this a crash.
Well, we're going to get more into the data. So anyways, the fourth indicator that you need to look at is the foreclosure indicator. And that's a really, really important indicator. And people can say foreclosures are doubling and we're seeing a lot of foreclosures, and we are seeing many more, especially in the FHA market, than we were seeing, previously. However, they're down 25% since 2019. So the foreclosure indicator is one of the indicators you definitely want to be following. But like I said, they're down 25% since even 2019. So that really shouldn't be at this point something that, worries anybody at this time.
Yeah, this is just one more reason. In 2008, the defaults and foreclosures was off the charts, right? And we're not even close. The difference this time around is people have a lot of equity in their homes. That's a huge difference. When you have $1, $2, $3, $4, $500,000 of actual equity based on what the market gave you, and you go from 300,000 back to 2 or 300,000 to 250, you're still in really, really good shape. And so there's, if you have that much equity in your home, you are not going to let that home foreclose. Now let's go back to 2008, 2009, which I went through. What happened was people got mortgages and then the home prices went down below the mortgages. That's a very different scenario. If you're sitting in a home and you have negative equity, and and the repercussions are you walk away, but now you move away from that negative equity. And now, by the way, there were tax consequences and all these things that followed those people that actually were foreclosed and defaulted. But the point is, it's a very different scenario. You're going to have less foreclosures. You're going to have, you might have some technical defaults. You might have some missed payments. You might have a lot of stuff. You might have a restructuring. But when a bank sees that you have $200,000, $250,000, $300,000 of equity sitting in your home, you are in a much better position than if you have none or it's negative. And that's the big difference. And we're not even close to that. And that's why I just don't think that, between inventory, days on market, list price, and the discounts and this increase in foreclosure, those are four big reasons why this market is still healthy.
But let's look into 2008 now and look at these indicators in 2008, because you just kind of went through what we're going through now, which is a slowdown. But a slowdown, can turn into a crash. Like, we don't think it's going to, but it can. So these are the indicators you're going to want to look at. So the crash signals that were in, 2008 were a massive oversupply from builders. So right now we have a 9.5 month supply. In 2008, we had a 13-month supply from home builders.
something to watch, right? We already went over this. So yeah, absolutely. But on the other side of that, you don't have this oversupply of single family houses. It's sitting in the builders category. So, and so, yes, we could see massive discounts to move some of that inventory, but it's not going to hit the common person. The common person is going to actually be the benefit of that. What it's going to hit is the shareholder price for, these Pulte, Lennar homes. That's who it's going to hit. It's going to hit corporations. I don't think anybody's crying over that. So, when both are up, when supply is up on the right now it's at 4.6 and it's up on the home builder, then I think you got a point. But right now it's just up on the home builder
So
side.
that's my next point. So you need a triggering factor, right? So the triggering factor, because you need, people aren't just going to sell their home in a bad time to sell just because they decided they just want to move and upgrade down the street, right? So you need a triggering factor. So the triggering factor in 2008 was obviously the subprime mortgages. So there needs to be a triggering factor here that would make all of these other people, not the builders, list their home in a bad time to sell. And that could be some kind of massive job loss. Like that's really the only thing, because they're mostly all in low rates and they can afford their payments without an issue, especially if they bought before 2021. So the big issue would be if something were to happen with the economy that would really affect the jobs and the government did not step in to help.
You mean like the lockdown?
Yeah, like the lockdown.
I mean, it's not
well,
funny,
but not even, because the government stepped in to help.
Well, we looked, I looked into this before because obviously, to your point, Chris Voss would call it a black swan or something like that. I think, when you have, what was the number, 750,000 people that are going to be affected. By the way, these are homeowners, these are renters, who knows what'll happen. There could be some kind of, COVID, stimmy money thing for this, right, to fix this. I think this is going to be temporary, but who knows, right? It seems like both sides have their feet dug in on this issue. But regardless, when you have 750,000 people that are in jeopardy of not being paid, it's a huge issue. It'll ripple through the economy. And we're not going to go down the AI route here, but that is another one. So to your point, if I was a betting person and I was to say what could potentially flip the script on all this, it could be job loss because it's already ticking up a little bit. The AI thing is a bit of a question mark. You read stuff on both sides of the equation. It's not going to affect anybody, and it is going to affect everybody. I'm personally hearing a lot of, from coders to paralegals to graphics people to content writing, marketing. Like I'm hearing jobs being replaced in that area, and they're not necessarily getting fired, but they're not replacing them. So I think to your point, that could be something as people go through these lifestyle adjustments. They're going to have to adjust and take a look at whether they can afford whatever's next.
But you have to remember too, so the thing that happened in 2008 is people were putting zero down on a mortgage. And right now you can still do that on a VA loan, but it's really the only loan you can do that. So I was just talking to a woman the other day that they actually are going to be walking away from their home because it's worth like $20,000 less than they bought it for, right? And she has a VA loan and she didn't put any money down and it's going to hurt her credit for 7 years and she's just going to walk away from it because her husband got transferred. However, most people have money down and that's the difference. In 2008, a lot of people had zero down. So it's very easy to walk away from a home that's worth $20,000 less and you're starting to have financial issues to just be done with it, right? However, when people have 10 or 20% down on a $400,000, $500,000, $600,000 home, that's real money and that's a lot of money. And it makes people think, should I walk away from it? Should I figure it out? Because you're walking away from all of that money. You don't get any of it back. So that is a huge distinction right now too, that you can't ignore because it's going to really keep people in their home unless they absolutely, no matter what they do, can't afford it.
That's a good point. So after this commercial break for our monetary metals, which by the way, gold's almost at $1,000 an ounce. It's insane. We're gonna talk about where does affordability come into play. So just after this. Near all-time highs. But appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. So let's jump into these National Association of Realtors Affordability Index, because that is another thing that we can look at.
Mm-hmm. So it's at a multi-decade low, right? So things are much less affordable than they were in 2019, significantly. So you do have to, put that into play. And I think that's why obviously we don't have a lot of buyers, because they can't really afford it. But that's why we talk about what Trump or the administration might want to do to try to make it more affordable. And we've talked about 40-year mortgages, which gets everyone riled up, but it does lower the monthly payment. And we've also talked about, different kind of incentives to buy a home and lower interest rates, because all of that is going to make home prices more affordable.
Right. And I think, it's interesting because we try to watch all kinds of indicators, not just real estate. Another one to watch right now, it's starting to pop up, is the used car market, right? And the new car market. So while it's not exactly the same, it's an interesting comparison when you start to look at used cars or existing homes and new cars or new homes, let's say. Well, what we're starting to see is people are bumping up on these $700 a month car payments, right? And this affordability index is important because the mortgages, as you guys know, we're at I can't remember, it's like a 25-year high of the difference between the mortgage payment and rent. So right now in most markets, it makes complete sense to rent because the mortgage payment is so much higher. That's at today's rates, at today's prices. And so now we have to turn to, as these things start to pop up and people start getting priced out of these monthly payments. Even my son came to me last month, and he's like, I actually have the down payment, is what he said to me. But what I'm struggling with is the monthly. It's a fair thing to bring up, right? And so I think a lot of people are in this scenario is they might have the savings, but they don't necessarily have the money coming in to cover the monthly. So now let's jump into these what you call the Trump rate cuts.
The Trump rate cuts. So, so if mortgage rates do fall from where they are now, which is about 6.3% as of today, if they go below 5.5, you're going to see, days on market shrink, sale to list ratio tighten, fewer price cuts, and median prices stabilize, or maybe even have an increase, because that's what lowering interest rates does.
So I'm going to go out on a limb here. We got 2 more Fed meetings between now and the end of the month. We got one this month and one, I think it's the very first week of December, if I'm correct. They are going to lower rates in both of those meetings. And so if that's the case, I think you're going to go into 2026 with 3 rate cuts, at least 0.75 to 1%. Right. And then that could get us down into the 5s.
Yep.
Right. So we could be sitting into the beginning of the year into the 5s. And there's a bunch of reasons for that, because for sure they're looking. And by the way, you know, whether you like it or not, you know, these big corporations, these big home builders, they're financed by banks. You know, when you have all this excess home building inventory, you know, trust me, the people are taking notice, because you need homes to close. You need the cycle. You need lenders to lend. You need mortgage, mortgage and title companies. They get paid commissions. Realtors get paid commissions. All that stuff. Right now, the economy is a little bit of a standstill from that regard. And I think that if we roll into next year with these rates in the mid fives, you're going to start to see in Q1 refinances. You're going to start to see some of this inventory move. And again, it's the beginning of what potentially could be a bubble too. So you got to be careful. So that would mean that there would be a window. So so perhaps it would be a good time to buy a new construction home from a builder at a deep discount, and then go into a refinance period of next year.
Yeah, I mean, if we're going to be talking about this on our podcast on Thursday, but the Fed's going to have less data to look at because of these government shutdowns, and so it'll be interesting what they decide to do based on other data that they have. But to Ken's point, you have to look at the UK and other places that have lowered interest rates a year ago, right? They've done what we're doing a year ago. So that's really good data to have. And in the UK, their housing market is pretty busy again, right? It's busier than it has been since 2021. It took a year. It takes time, but you also haven't seen huge price increases, which is interesting, but that could point more towards less demand than they thought, but still a stabilization in prices. So their prices aren't going down. They're just not going up like they thought, but inventory is moving.
Well, we were in the UK in May, and I'll tell you, so again, what happens is when the rates go down, things move slow. And then, it takes a while to close a house. It takes a while for the money to move through the economy. Of course, a lot of people are going to look at rates continuing to go down into 2026, which is going to be extremely interesting because Powell's out of there in May. And I think it looks like Trump's going to try to stack the deck over there. I don't know if that's going to work, but we will see. But the reality is just like in the UK or in Canada or some of the other markets where their central banks lowered their rates way before us, it takes a good year plus for that lag. There's a lag, and that's the lag, in my opinion, that's the time frame when you want to buy. You want to buy when there's distress. And if the market is signaling where you're going to start to see these interest rates potentially go down, then what you do is exactly what Ross and I did. Because Ross and I did this. We actually owned a bunch of real estate, and we financed it at one number. Back then, by the way, it was 5%, 6%, 7%. And then we actually took advantage of the cash out refis. Kept the properties, by the way, as the rates continue to go down that period of time. And, Trump's still got, 3 years?
Yeah.
So, he's going to keep beating on this drum. And whether you like the guy or not, all you got to do is go back to his past behavior when he was president already. And he's a real estate guy. He comes from a real estate family. And so all of that, I think, is going to benefit anybody who's in the real estate space. Now, that could change again, obviously, when there's a new administration. But you've got this little window here, and that's all I'm trying to say.
Yep. So we will see, but check out our podcast on Thursday. We're going to be going over, what to expect with this government shutdown and how it's going to impact real estate. Yeah. See you guys then.
Okay, guys. See ya.